Okay, well, let's jump into it here. I had a question. I hope that something didn't happen. There we are. Okay. So this is from economics, and it was talking about currency. And the question was about the forward rate and the spot rate, and a table kind of like this they were looking at. So I thought I'd just fill this in just with a couple of points. Some things you may know, but let's just put this down here so that we're just aware of, just to know what we're looking at. I think that's half of the battle in terms of these questions. So of course, these are referred to as the currency pair. The currency in the numerator, this is referred to as the price currency, and the currency down here in the denominator, this is referred to as the base currency. So I think that we've got to know this. Just this language of the price currency and the base currency. Okay, so that's number one. All right, we've got that here. We're going to talk about what these points mean. How do we use those points? Because I think that you're going to need these, whether it's, I think there's possibilities in terms of different question combinations that will show up. Okay, so we've got the price currency, the base currency, and the points. Okay, that's the step one. Step two, just to think about the forward rate, the forward exchange rate. There's a relationship here. We've got the spot exchange rate. And now what we're going to do is we're going to add, and I'm just going to write it this way. We're going to add the points, and those points are going to be scaled by 10,000. Okay, and this, I'm writing it as plus here because what you'll notice in terms of the points here, there's a plus sign and there's a negative sign. So if it's a plus sign, then we're adding it. If it's a negative sign, then we're subtracting it. Sometimes you'll see this written as plus or minus the points. The plus or minus refers to the plus or minus sign in front of the points. Okay, there it is. That's what I just wanted you to be aware of. Okay, so we know this relationship. All right, now the related topics that I think will be coming in terms of questions are related to premium and discount. Premium and discount. So the language that you may come across in a question is, which currency is trading at a forward premium or a forward discount? Are they talking about the price currency or the base currency? Well, the forward premium or discount is just simply indicated by the forward exchange rate. And we compare this to, well, actually, let's write this in a line here so I can do it neatly. The forward exchange rate compared to the spot exchange rate. And we say that the forward is trading at a premium if it is bigger than the spot. That's it, nice and easy. And we say the forward is trading at a discount if the forward exchange rate is less than the spot. So we may need to calculate that forward and spot and compare the two. So that's one way to be able to identify the premium or discount. Now there's another way, just by knowing what we're looking at. We can come right over here to the points and crack the code this way. If the points are positive, then we have a forward premium. And if the points are negative, then we have a forward discount. So now we're halfway there to our solution. The question is going to be, which currency is trading at a forward premium or discount? And the trick that you want to look for in your answer choices is this forward premium or discount. It always is referring to the base currency. So whatever the base currency is, the euro or the Canadian in these currency quotes, this would be what we would be looking for in terms of our answers, okay? And we're going to fill this in because you got to be sharp, because if one currency is trading at a premium, the other currency is by definition trading at a discount. Okay, so there it is, nice and easy. And now let's just fill in this chart here just to complete this, okay? So for the Canadian euro currency pair, if I wanted to get the forward rate, it would be the spot rate plus, so that's 1.5514 plus 222.5 points divided by 10,000. And so this comes to 1.5736. And we've got to go to 4 decimal places there and make sure that we round off appropriately. Okay, so now we have our forward, and we can tell, I'm just going to erase this at the bottom here. We can now tell that the forward is trading at a premium. Well, we knew that from the points right away. And now the question is, which currency is trading at a premium? It is the euro, which is trading at a premium. The euro is trading at a premium relative to the Canadian dollar. Or equivalently, you could look for the statement that says the Canadian dollar is trading at a forward discount to the euro. So we've got to know this, okay? All right, there it is, nice and easy. And now let's look at the second currency pair here, the British pound per CAD. That's how we would say this. So we're given the forward, and we want to go back to the spot. So remember, the forward is going to be equal to the spot. And in this case, we're going to subtract 100 basis points and scale that by 10,000. Okay, so let's just, we don't know what the spot is, but we know what the forward is. Let's enter that here. Our forward is 0.5988. And of course, if we do this math, okay, let's calculate this. We're gonna have the spot equal to, I'll just bring to the other side. I'll write it this way: 0.5988 plus 100 divided by 10,000. Okay, and so what do we end up with? 0.5988 plus 100 divided by 10,000. So I'm just using my calculator to calculate it here. And I end up with 0.6088. Okay, so this makes sense. The forward is less than the spot. We're trading at a forward discount. What currency is trading at the discount? It's the Canadian dollar is trading at a discount relative to the British pound. Equivalently, the British pound's trading at a premium to the Canadian dollar. Okay, so we've cracked the code to know how to use this table. Now let's get rid of this and fill in another question that potentially is coming. So what I think that they're going to do on our exam, because they only have a limited number of questions and they can't do them all, they're going to give you a table like this. You're going to have to complete it quickly, fill this in. And now the question will relate to the cross rate. So what is the exchange rate if we use the two currency pairs? And in this case, I'm just making up a simple example here. But if I wanted to calculate the British pound per euro, then I would look at the quotations that are given and I just line them up so the math cancels each other out. I've got British pound over CAD, and I'm going to multiply that by CAD over euro. Okay, these are the quotations that are given, and I can see from the math that the CAD will cancel each other out, and it will leave me with British pound per euro. Now, make sure that you read the question carefully, because the question could ask us for the cross rate in terms of the spot, or it could ask us for the cross rate in terms of the forward. It doesn't matter which one they're asking. We do the same math, okay? If it was the forward, I just use this column. If it was the spot, then I'd use this data right here, and I could calculate it. So I think that this is cracking the code on an easy mark that's coming on this exam, okay? Where would this get to be a little bit tricky? This would get to be a little bit tricky if one of the currency pairs was inverted. If we were not given, let's say, British pound per CAD, but instead, what if we were given, and I know this isn't going to, you know, I'm not changing the numbers and such, but what if we were given the quotation as CAD over British pound? Then what we would need to do is calculate these items. Let me clear this off. It's getting to be a little cluttered there. Okay, let me just fill this in right here. Okay, so let's say that we change this around here. Okay, here's the high-tech portion here. Okay, we're going to grab this and we're going to put it on top here. Let's hope it works here. Okay, there it is. Okay, and let's make sure that I can get rid of this this underlining here. Okay, we'll get rid of that and we'll drop it in here. Okay, there it is. Okay, so I didn't change the numbers. Okay, of course these numbers would be something different. Okay, it doesn't make sense here. And if this were the case, I'm just gonna change it to something that, you know, I'm just making this up. I don't know if this would be the exact, but let's say 1.687, 1.678. I don't even know if that's the quotation. I'm just making up. Okay, so now we set the stage here, and now we are asked for the cross rate. Let's say it was the forward, so I'll keep that. Okay, I'll fill in my forward here. We'd calculated the forward before as 1.5736. We already calculated that, and now if I want the cross rate, which is, we're talking about the forward here. So the question saying, what is the cross rate for British pounds per euro? Okay, so in order to do this, let's just go through the steps again. Okay, so what do I want? I'm going to need, I want, let's see here. Let's see here. I've got CAD over euro. That's okay. And then I want to have over here, I want to have British pounds over CAD. Okay, but we're not given British pounds over CAD. We're given the inverse. So I better just get rid of this and write it correctly here. We are given CAD over British pounds. So what I need to do then is do the reciprocal, which is 1 over. So what you could do is, you see in the textbook, sometimes they put this to the exponent -1. Any number to the exponent -1 is simply saying 1 over that exponent. Okay, there's the math for you if you wanted to make sure you know how to do the math. But what I would do really quickly is I would simply just fill it in, and I would do this. Okay, I've got my 1.5736, and I'd multiply that by 1 over 1.678, and this is going to give me my answer. I would complete that calculation. So from this little table here, I think that there's potential for 1 or 2. I mean, I'm really confident that 1's coming. Come on, let's put stars right beside this cross rate. You got to be ready for it. You got to be ready for inverting the currency and going from there. You got to read it carefully to know what you're looking at. Okay. All right. I hope that's okay. Good. Okay. All right, one other, let me just back up just to say the other potential questions. Remember, those were the forward premium or discount, or just simply calculating the forward from the spot, given the points. Okay, that's it. Okay, good. So, I mean, that's an easy concept. And so let me clear this off. And just while we're here, it wasn't asked, but I'm just going to put it up here anyway. This is not related, but just another concept which is referred to as interest rate parity, IRP. Another relationship that you'll see, you know, is the forward is equal to the spot adjusted for 1 plus the interest rate over 1 plus the interest rate And these are the interest rates in the two different countries. Now, let's just complete this, because it was always tricky to me. How do I know what I'm doing? Well, here's how you know what you're doing to stay consistent. Let's say we're using the currency pair CAD over euro, okay, C over E. Then just be consistent. The spot exchange, CAD over euro. And now which interest rates do I put? Just look at the quotation. In the numerator is the CAD, so this will be the interest rate in Canada. And then in the denominator, the price, the base currency, that would be the rate, wherever this euro's from. Okay, there it is. Just stay consistent, and that way you won't make a mistake. It's nice and easy. This is the interest rate parity. We can calculate the forward exchange rate from the spot given the interest rate differential in each of the countries. And one other point just to be aware, okay, these interest rates, okay, make sure that you adjust them. You are going to be given annual rates. So if you were talking about a forward rate that was only 3 months or 1 month, then you'd have to adjust these rates by dividing by, well, let's say 4 dividing by 12. Okay, you could put things to the exponent. If you know how to do it that way, it comes out to the same answer, very, very close. Okay, but just make sure that you adjust those rates. They are annual rates. Even if they say something like 90-day rate, it's an annual rate. Okay, you guys okay with that? Okay, good. Okay, another concept that I think is coming, and also could just be a build-up for level 2. Okay, well, that was the first question that came in. I hope that I covered it. Now, let me scroll down here and talk about trade and a tariff, okay? So I prepared this picture here. I certainly, 99.9% really confident that a question's coming on the effects of a tariff. And so just down the side here, I just want to say we've got to keep our eye on the consumer surplus, that's CS, the producer surplus, PS, the government revenues, I'm just going to say G, and the dead weight loss, which I'll talk about, and then the effects on total welfare, TW, national welfare. So I think that the question's coming at you, and it's going to talk about a tariff. What is a tariff? It's a tax, okay, placed on imported goods. Okay, there it is. It's to discourage imports. That's really what it's used for. Now, in our CFA curriculum, I think the question's going to relate to the effects on the consumer surplus, the producer surplus, or the government gain, the revenues, or the deadweight loss, or the total welfare to society. Okay, so first of all, if you don't know what consumer surplus or producer surplus is, go back, look at the preliminary readings, look at my little video on that. I think that'll help you out. If you're still in trouble, just send me an email and I'll give you a quick explanation. Okay, that's the first thing, okay? So you got to know this. Now, the next thing is to just fill in the general points here, okay? The general points are that the consumer surplus decreases. So domestic consumers lose when there's a tariff, okay? And the producers, the domestic producers, they gain. There's a little windfall for them. So it could be labeled, and the language I want you to look for is a reallocation of this surplus from consumers to producers. That could be the answer choice. That's how they kind of disguise it. Now, with a tariff, it's a tax, so there's government revenues, okay, that happens. And now this is an intervention into the economy. And so there is a lot of activities which go on, which create inefficiencies. That's referred to as a dead weight loss. So there's always a dead weight loss created. Now, overall, what is the effect on the total welfare or the national welfare? It doesn't always go down. Don't think there's dead weight loss, so it goes down. What it comes down to is the effects of the dead weight loss versus the government tariff revenue. Whichever one is greater has the overriding impact. So if there's only a small deadweight loss, but a large increase in government revenues, there may actually not be a decrease in our total welfare. So you don't have to go any further than that. What I want you just to take away is this. Here's CFA Institute's signal. They talk about a small country and they talk about a large country. Okay, so a small country means you don't dominate the world market, and there will be a deadweight loss, which is most likely going to outweigh any government revenues. So with a small country, there will be a decrease in the total welfare or the national welfare. Okay, that is okay. Keep that in the memory banks there. A large country, so it doesn't mean large like a landmass like Canada, but large country dominating, influence over the world price. The CFA answer that you're looking for is, question mark, or there may not be a decrease in total welfare. Either of these type of answer choices I could see coming. So the language is there may not be a decrease in the total welfare, or there's inconclusive. So we're not sure. Okay, that's how I think that they're going to put it on the exam. So the first elements from this tariff, I think we've got to know these type of qualitative items here. Okay. All right, let me clean this off and clear this up here. The next potential question is looking at this picture. And I would make sure, okay, wink, wink, nudge, nudge, okay, you know this picture, okay? I think it's coming on your exam. So we've got to get into our understanding of what do these areas mean? What's area A, B, C, E, and F? What do these represent? That's what I think they're going to say on the exam, okay? So now let's just fill them in, okay? And we'll figure out spots to put these in. Areas, first of all, consumer surplus. Remember we said consumer surplus. This goes down. Well, the consumer surplus goes down by, they're the big loser. It goes down by A plus B plus C plus E plus F. All of the area consumer surplus decreases. All right, that's number one. So they could have a simple question that says, to either they could have these, I doubt you have to calculate them, but it could just ask you the question I have in mind, just asked you to identify the areas there using these letters. Okay, the next, I said there was an increase in producer surplus. So these are for the domestic firms, and that's equal to area A plus B. Okay, just this area over here. Okay, there it is. All right. Now, what about the government revenues? Okay, so the increase in G, the government revenues, that's represented by this area C. Okay, the government revenues from the tariff, from the tax. And the dead weight loss, this is represented by the two triangles E and F. E plus F. Okay, you don't have to go any further. Don't dive any deeper here. Okay, what you want to do is get exposure to the CFA Institute questions to see how they're attacking it. Okay, you want to see how they are now approaching this. But I think that you're going to see a question that looks like this. Okay, this is the effects of a tariff. Okay. Now, in terms of the picture, let me explain some of the other items that are here. Okay, let's clear this off. So first of all, let's just see here. This label, autarkic price. So this represents the equilibrium price in the domestic market under the condition of no trade. And you can see here is the demand curve right here, the domestic demand curve, and the supply curve. This is the domestic supply curve. Where they intersect, that's the equilibrium, of course. That is referred to as the autarkic price, or the price in autarky with no trade. Okay, that's number one. Okay, we've got that. Now, from this picture, the next thing that I want you to know is down here, this is not the domestic price. I don't think that that is labeled accurately. Okay? I think this should be referred to as the world price. Okay, I threw that in there just to see if you were awake and you could catch that. This is the world price. Okay, now the world price is below the autarkic price. So what happens here? Well, if we follow along at this world price, the quantity that domestic producers are willing to produce is right here, and the quantity demanded by consumers is right here. There is a shortage. And so the quantity demanded is greater than the quantity supplied. That's a shortage. The shortage is satisfied by imports. Okay, that's what happens. So you can see this. This is not written in our textbook. I've put it out here. This supply curve, this represents the domestic supply plus the imports. Okay, so that supply curve has shifted. Okay, to the, I hope this is shifting to the right there. Supply has increased. All right, and it has increased, and now we are at a new equilibrium. Okay, the equilibrium is being satisfied by imports. Okay, so what happens now? Well, the government comes along and says, we're going to place a tax on this. That is the tariff, and it brings the price up here with the tax. So what happens now with this tax? Now what happens is it discourages some consumers because the price is higher. So the quantity demanded now decreases, and it encourages some lucky suppliers domestically because they can charge a higher price. So here's the quantity supplied domestically. So what it has now done is it has now decreased the imports because now the shortage has decreased and the amount of imports required to satisfy the demand has decreased. So, okay, I'm going way beyond the CFA exam level for what we need here. Let me dial it back here. I just want you to make sure that you know this picture. Make sure that you know these areas A, B, C, E, and F. They might be labeled 1, 2, 3, 4, 5 or something on the exam. They might be labeled G, H, I. Okay, just you know the shapes for where they fit in. Okay, now I hope you do. Okay, don't just go with the letters. Number 2, I just want to make sure that you understand what the language is here. Okay, and what autarkic means, what the world price means, and what the price with the tax or the price with the tariff means, so we can interpret this. And then come on, this has got to be coming, that reallocation of the surplus from consumers to producers, knowing which of these components fit in there. That, I think, is coming on our exam. Okay, so this was another question. Okay, good question. I hope that's okay. All right, good. Okay, so let's clear this off. And now, okay, let me just scroll down again here. And the next question, boy, okay, this next question, hey, it's a blank page. Okay, so this next question, okay, this is, we've got to dive into this. I think it's a concept that's coming on our exam. I wanted to write it out here so that we could see how it develops. The text over the years, I'm talking about the CFA curriculum text, has cleaned up the material. They've removed some, you know, a couple of years ago it was just dropped in and questions were all over the place. Okay, and I don't know if those questions are still hanging around on the online question test bank from CFA Institute. Okay, now if they are, okay, then make sure that they are, you know, reflective of our current curriculum. I mean, if anything looks unsure, then, you know, send it to me, let me know. Okay, what I'm getting into now is talking about the fundamental relationship. Okay, so the fundamental relationship between, I think we've got to know this fundamental relationship between savings, investments, okay, the fiscal balance and the trade balance. That's what I think that we're after here, okay? So, so the fundamental relationship between savings, no, I'm so excited to write it down here. It's coming on our exam. Savings, investments, the fiscal balance, G minus T, and the trade balance, exports minus imports. Okay, so we've got to make sure that we can put this together here. Okay, so where does this you know, come from? Okay, well, let me help you out with this. So there's a section talking about measuring the economy and output and GDP. There's the income approach and there's the expenditure approach. I think that you really you know, must focus on that expenditure approach where we had output or income, it means the same thing, is equal to C plus I plus G plus exports minus imports. I'll put that in a bracket. So this is telling me that the expenditures are equal to the income. So let me just give ourselves a little bit of space here, okay? And put this up here, okay? So let's just fill it in here so that we know what we're talking about. Y can refer to income. And then C plus I plus G plus X minus M, this is equal to the expenditures. Okay, so when the economy is in equilibrium, the expenditures equals the income. If somebody spends $1, someone else earns that $1. That's what we're saying, okay? All right, so let me take this a step further. Your income can be broken down into a couple of items. Well, there's consumption, so we can go out and we can use it to buy goods and services. We can save our money, and part of our money then goes to taxes. So the income is broken down into consumption, savings, and taxes. And now if I set this equal to C plus I, which is business investment, plus G, which is the government spending, plus exports minus imports, which is the trade balance. And now just do a little bit of you know, canceling here. We will come up with the fundamental relationship. So let's see here. The consumer spending is on both sides of this equation. So we can cancel. C will cancel. So what are we left with? I'll write it out here. Savings, and I'll bring the taxes over to the other side. Savings is equal to investments plus G minus T. I'll put that in a bracket. That's the fiscal balance plus exports minus imports. This is the trade balance. So this is the fundamental relationship. And what you're going to look for on the exam is language that says Savings can be used to fund business investments, or it can be used to fund the government deficits, or it can be used to fund our trade balance. So I think that you've got to make a connection here, because the same language shows up later on in reading that relates to the balance of payments and trade. So I think it's coming on our exam. I think this is something that we need to know. Okay, so let's make sure that we know this. Okay, let me erase this and put up put it up here at the top. Fundamental relationships: savings equal to investments plus G minus T. And be careful here, because some textbooks write T minus G. Watch out. Plus exports minus imports. Okay, so the government spending, this is the expenditures, and the government taxes, that's the revenue. This is kind of backwards. When you talk about it, when you talk about a budget, normally you talk about the revenues minus the expenses, but this is the expenses minus the revenues. Okay, so make sure you know this, okay? That you know what you're watching here, okay? Now, a couple of trivial points that are coming, I think, on this exam. What happens as income rises? Okay, so as our national income rises, which could trickle down to our individual income. Well, let's just think about what's happening here for the income. Well, the government spending, there really isn't any effect on government spending, but taxes are a function of income. If you have higher income, you have higher tax revenues. So what you need to take away is, and look for these type of signals and connections, higher income will lead to a lower deficit. That's a budget deficit. Why will it lead to a lower budget deficit? Because, and I'm going to write this in red, we have higher tax revenues. Okay, remember, this is written kind of backwards. Okay, you guys okay? What else is the effect of higher income? Well, we feel more wealthy, we import. So the trade deficit worsens, okay? Why does the trade deficit worsen or increase? This is because imports increase. We have higher incomes, so we start buying more, we start importing more. There it is, okay? So I think that they highlight this in the curriculum. There could be a trivial point that's coming in terms of, what happens if income changes. Look at the online questions. I think you'll see some trivial points there that fit in here, okay? The other kind of trivial point that I think could fit in here is just trying to think about things like, what happens if G is greater than T? Okay, so first of all, what does this mean? G is greater than T. It means that we have a deficit. Okay, this is a fiscal deficit. This means that the government is spending more than it's bringing in tax revenue. Okay, so if there is a fiscal deficit, then by definition, there must be, and this is what you're going to look for on the exam, either an excess of savings over investments, or, okay, it could be both here, exports less than imports, or a trade deficit. Okay, so I think that these are, the trivial kind of level that the exam question is going to get to. I talk about it being a trivial level. It's not so trivial, okay, but they look innocent, really innocent, but I think that they can cause you a lot of trouble here just because of the language. So you've got to get into that CFA Institute type of question. This is not like a pure economics exam, economics is used as an input tool for our investments, okay? And that's where this is coming from, okay? So the fundamental relationship, I think that's coming. I think you've got to be aware of it, okay? And let me just clear this off and, write it this way as well. So we had savings equal to investments plus G minus T plus exports minus imports. Now, you may also see this with the investments brought over to the left side of this inequality. So this could also be written, and you may see this as savings minus investments is equal to, and now on the right side, the government deficit and the trade balance. Okay, so I think that's the way that you may be able to see this. And this is going to lead us into concepts of building up, well, the aggregate demand and points along our aggregate demand curve, and those concepts of the IS and LM models and curves, okay? So this is a big roadblock, a big study trap, okay? Don't get caught, bogged down. I mean, in the curriculum, they just drop this in there. I could write 20 questions just on the ISLM. They drop it in here, and I think that we need to make sure that we can handle this, okay? So let's crack the code on this and put it together. Okay, so I'm going to start by clearing this off and go to kind of the end. So let me just draw a graph over here. This is going to be price and GDP. Now that says GDP, okay. Bad handwriting. Okay, now I could label this also as the word output. Okay, GDP or output. I could also label this as income. Okay, sometimes you just see that as the letter Y. So I just want you to be aware that whether they talk about GDP, they talk about output, or they talk about income, they could all be the same item there, okay? They all refer to the same item. So we have a relationship here between output and price. We have a relationship between price and income, or a relationship between price and GDP, price and output. Okay, and this is building up to what's referred to as the aggregate demand. The aggregate demand curve, okay, is a representation of the demand for all of the goods and services in the economy at different price levels, okay? A relationship between price and output. That's what it is. So we're going to build up to this, okay? So we need to then come over and talk about the goods market, MKT, and the money markets, MMKT, okay? So the goods market refers to, well, the expenditures, the planned expenditures versus the actual output. Okay, so they talk in the textbook, they start talking about inventories. If inventories build up, then the planned expenditures are below the actual output. Okay, so they start to make links there. Okay, do we really need to go into that? I don't think so. What I think that we need to do is say the IS model, the investment savings model, relates to equilibrium in the goods market, okay? And this equilibrium in the goods market is represented by savings minus investment equal to G minus T plus X minus M. We've seen that equation before, okay? So we know this. And so this is the equilibrium in the goods market at a specific interest rate. Okay, I'm going to write R as I'll write an I as an interest rate, I, at a specific interest rate. Okay, so when the planned expenditures are equal to the actual output or the actual income, then the goods market is in equilibrium. What's another way of writing this? Another way of representing this is the expenditures are equal to the income. What does that mean? That's our good old friend Y. Y is equal to, make sure that's a Y, C plus I plus G plus X minus M. It is. We know because we went through the mathematical exercise to rearrange it to get to the fundamental relationship. But what I want you to do is know how to use this on the exam. So this formula we know as the expenditure approach for calculating GDP. I also told you that GDP is the same thing as saying income. Okay? Income, output, GDP, it means the same thing. So if you are given a question that asks you to find the IS equation, then this is it. You're solving for, here, let me just clean this up here. The IS equation is right here. That's it. We've got it. So if you're asked a question on the exam about solving for the IS equation, there it is. You're plugging it in. Y is equal to C plus I plus G plus X minus M. And you may have to simplify and simplify. This is back to high school math. Okay. So there it is. The IS model represents equilibrium in the goods market at a specific interest rate. It's where the planned expenditures are equal to the actual output. That language has to resonate. It's got to be in your mind there. It's where savings is equal to investment is another way they could represent this. Okay, so there it is. Okay, and the key component that I want you to take away is this interest rate. The interest rate adjusts to bring us back to equilibrium in the goods market. And what I mean by this is, now this may be going too far, but I'm going to put it up here anyway. Okay, so I'm going to put it up here. So if the savings is greater than the investments, so if we have excess savings over investments, we need a mechanism that will bring us back to equilibrium. And the mechanism that's going to bring us back to equilibrium is a decrease in the interest rate. You could say a decrease in the real interest rate if you want to be more technical, but just a decrease in interest rates. Why will this bring us back to equilibrium? Well, what it's going to do is lower interest rates is going to discourage savings. So the savings component is going to come down, which is what we want. And the lower interest rates is going to encourage investments. So that's what we want. Okay, so this is going to bring us back to equilibrium. So the mechanism which adjusts is interest rates. Okay, if I write it differently here, if I write down, what if we had savings less than investments? Okay, what if there was an excess of investments or a deficit of savings? Maybe income's way too high. That national income, the economy is doing really well. Okay, well, what mechanism will bring us back into equilibrium? Interest rates will rise. What will the increase in interest rates do? Well, it will stimulate savings. Okay, remember, this is just in theory. And it will decrease or discourage business investments. The cost of building these factories becomes too expensive. Brings us back to equilibrium. Okay, so what I was thinking was I was going to do this this goods market, then I was going to do the money market, and then I was going to show you over here on the aggregate demand curve, 3 curves in a row. Okay, it may not work out because of my space. Okay, so I don't want to cram it in here. Okay, you guys okay so far? Okay, All right. Okay. Well, okay. Let me clear this off because I want to use. We'll put it back up here. I want to write it out again here. Okay. And I want to make sure that we can take away some of the trivia here. Okay. So in the text there is a graph that looks like this, and it has income and it has real interest rates. And so what does it show? It shows a downward sloping line here, and it shows an upward sloping line here. Okay, this is a representation of the goods market. Goods market. Okay, now what is each of these lines representing? Well, the upward sloping line is representing the savings and investment component. And what it says, things that we just mentioned here. Okay, so let's just think about this. As interest rates rise, it's saying that the savings investment rises. Higher interest rates causes higher savings. But I said higher interest rates lowers investments. The assumption is the effect on the savings is much larger than the effect on the investment. Do you need to know that? No, I doubt it. Okay. All right. What about this curve going down here? Well, this represents the fiscal balance plus the trade balance. And what is it showing? So this can tell us the relationships here. So we can see this as income increases, we know that the fiscal balance decreases. The deficit decreases. Why? Tax revenue going up. As income, as Y increases, we already said this. We know that the trade deficit increases. Why? Because imports increase. Okay, so we can see this already in terms of the relationship. Okay, so there it is. We've labeled our graphs, and now of course, when we're here at this interest rate and this level of output, okay, we are in equilibrium in the goods market. Okay, well, what happens if we are at an output level? Call it number 1 over here. And this is where the savings investment is greater than the expenditure component. Okay, I'm giving it away here. Okay, so over here in this scenario, I want you to map this back to say that the planned expenditures, so planned EXP, that says planned expenditures is less than the actual output or actual income. I don't know why I switch between, doesn't matter. Okay, so I'm using Y here, that's why I'm talking. So the planned expenditures is represented here, okay, less than the actual. Okay, I guess that's one way to say it. I wouldn't even try to link it up here. What I would try to do, if you want to link it up to the savings and such, here's the language, and this is what I want to try to give you. So for the exam, okay, you're looking for this language about planned expenditures versus actual income or actual output, or they may use the language, and I'm going to write it here, I hope I can fit it in here. There is an excess of savings. Excess of savings. Okay, I didn't write it in there. Okay, so an excess of savings, or they might use the language insufficient. That says insufficient. Boy, my handwriting is terrible. Okay, insufficient. Let's make sure you can read it here. Insufficient expenditures. Okay, kept you in a little suspense there. So let me just take a step back. Here's what I think that they're going to do on the exam in terms of the question. This output or this income level is the equilibrium income level. If output increases beyond the equilibrium level, that's what they'll preface the question with. What are you looking for your answers? You are now looking for planned expenditures are below the actual expenditures or below the actual income. Or you're looking for the language, there's an excess of savings, or you're looking for the language that says there's insufficient expenditures. Okay, that's referring to the planned expenditures. Okay, so just the language to crack the code. Okay, and it all starts right here. If the output or if the income increases, okay, that's it. Now, what happens if we go the other way? What happens if we drop down to an income level that's below? And so we're down here. Call this number 2. And we are now in this situation. Okay, on this side, we've got the reverse. Okay, and where am I going to write the reverse here? Okay, I'm going to write it over here. I'm going to change the color. So over here, what do we have? We have the planned expenditures, plan EXP, greater than the actual income, act income. Okay, we have deficient or insufficient savings, or we have an excess of expenditures. I don't think they would use that language, but I think that this is cracking the code to take us to be able to say, okay, let's know. You don't have to get into ISLM, the IS, well, here we're focused on IS here, too deeply. You've got to get the CFA language. That's what I want you to take away. So you're gonna be able to look at this and say, okay, equilibrium in the goods market, we're talking about the IS curve. All right, what are the components here? We're talking about now planned expenditures versus actual expenditures. We're talking about savings, investments. Okay, so what are we looking for? We're looking for signals in the question, what if the income level increases? If the income level increases, then I would take that as a signal from CFA to say that we're over here and we're in a situation where planned expenditures are less than the actual output or the actual income, or we have excess savings or insufficient expenditures. That's how I crack the code. Or if the income decreases, okay, now we're over here. Planned expenditures are above the actual expenditures. Okay, that's the way that I would think about it. Okay, so this is cracking the code in terms of dropping it down to the exam language. So now you've got to be able to match that up to practice questions. Okay, and one other element to this IS. Okay, this is not the IS curve. Okay, if I clear this off and I put up this graph here, so now I've got output and I've got interest rates. You could call this real interest rates, doesn't matter, interest rates. The IS curve is a downward sloping curve that shows a relationship between interest rates and income. And if we're on this line, any point on this line means that we are in equilibrium. What does that mean? It means the goods market's in equilibrium. The expenditures are equal to the income. The savings is equal to the investments. Okay, and we're in equilibrium at this specific interest rate. If we are off of this curve, let's say we're over here, we're over on this side here. How do we get to that? Well, let's say the income level has increased, okay? So we need a mechanism that's going to bring us down to equilibrium. So in this case, over here, the savings, let's see here, the savings is below the investments. Income is increased, and that's stimulated, business investments. Okay. So how do we bring this back into equilibrium? We need something which is going to stimulate. Did I say that? Maybe I said that backwards. Let me correct that here. Okay. Okay. Let's see. Yeah, I said it backwards. Okay. In this situation, okay, with an increase in income, I think I I should have remembered my previous graph. Sure, the savings, we assume the savings component increases more than the investment component. Savings is greater than investments. That's 100% in this situation. We need a mechanism that's going to bring us back to equilibrium. Okay, so what's the mechanism? It's interest rates. So we're going to have interest rates drop, and that will bring us back to the curve. So what does that mean? Interest rates dropping? Oh, this will discourage the savings, and it will encourage the business investment, bring us back to equilibrium. Okay, so there it is. If we happen to be on the other side here, if we happen to be over here, if the let's say the economy or the income decreased. So now what does this signal? Okay, now I've got it. Savings is less than the business investment. Okay, so we need a mechanism that's going to bring us back to equilibrium. The interest rates are going to rise. So if interest rates rise, this will stimulate the savings, and it will slow down the business investment. It'll bring us back to equilibrium. And the points along these lines represent equilibrium between investment and savings, equilibrium in the goods market. Okay, so this is the IS model. Okay, we're almost there. Okay, hang in there. Okay, let me flip over to the LM model. Okay, the LM. Okay, this is the liquidity monetary model. If you really want to know, it doesn't matter. LM model. This now is referring to equilibrium, EQBM, equilibrium in the money markets, MMKT. So what does that mean in the money markets? It means the supply of money, money supply, is equal to the demand for money, MD. Okay. And of course, we've got to be conscious of price levels. So we talk about the real money supply is equal to the real money demand. That's fine. Just money supply equal to money demand. Okay, where does this start from? It starts from, okay, this is an economics lesson going on here. Okay, hang in there. Okay, so it starts with something referred to as the quantity theory of money and the equation of exchange. So this says the money supply times the velocity of money, and the velocity refers to economic activity. How many times does a dollar circulate throughout the economy? If the economy is really doing well, velocity is high. That's what it says. So this is equal to price times the output. Okay, so we'll call that GDP and such, but okay, this is our equation of exchange, and we're just going to rearrange this. How am I going to rearrange this? Well, what I'm going to do, remember, this was the real money supply. I'll put R there. This was the real money demand. So what does that mean, real? It just means I'm taking into account prices. Here's my price level right here, P. Okay, so if I divide both sides by prices and I bring the velocity of money to the other side, I end up with this: the money supply over P. That's just code for the real money supply. I'll just write real money supply is equal to 1 over V, 1 over the velocity times the output times Y. Okay, 1 over V in the text, you'll see it, they change it to letter K or something like that. All right, this really is not the significant part here. What's significant is this. What's significant is that the equilibrium in the money markets refers to the money supply equal to the demand for money. So we can just slip this right in here, the demand for money, and we could say that's equal to 1 over V times Y. What are we really interested in terms of the LM model? We're looking at this part right here, okay? So we've kicked to the curb the 1 over velocity times the output, okay? Where will you use that 1 over velocity or the velocity times the output? You'll use that in a separate question, possibly about the equation of exchange, but not here. Here, I just wanted you to show the build up so that we could get down to this LM model. Okay, there it is. Okay, so we are in equilibrium when the money supply equals the demand for money. Okay, so now in our economy, in most cases, the money supply is fixed. Okay, I mean, the government could print more money, but let's say it's fixed. So what changes? The demand for money can change. And what is the demand for money based on? The demand for money is based on, well, incomes. So economic activity. If there's a higher national income, higher output, higher income, higher, I guess, GDP, okay, the economy is doing well, individuals demand more money. So there it is, increase in the demand for money. Okay. The reverse is the same. If the economy is doing poorly and if the income, national income is dropping, the demand for money drops as well. Okay. What about interest rates? Remember, interest rates are the cost of money. They're the price of money. So a higher interest rate reduces the demand for money. Okay, so interest rates and income, these are the components that I think we need to put together, okay? And so now just thinking about this in terms of the components of income and interest rates here, we can graph this, okay? And now if I do a graph that refers to real interest rates, then I could start to think about, remember, that's taking into account inflation. So if I talk about real income, a real increase in income, increase in R, real income, real, this will lead to an increase in the real interest rates. So, just think about that. If the economy is really doing well, then the demand for money is increasing and the price of money is really increasing, so that interest rate is increasing. So these are captured in a graph. So here it is. I'm going to put it up here. Let me clear this off now. Okay. Let's just see here. I'm going to try to get smart here. Okay. So let's see if I can do this. Okay. 1, 2, and 3. Okay. So let's just stay with the LM model where we were. LM. So we have the real interest rate and we have income here. And so the LM model, there it is. It's an upward sloping graph. And what does this show us? Along this line, it's okay. I should have drawn a straight line. Doesn't matter. Okay. The money market's in equilibrium. The supply of money is equal to the demand for money. The real money supply is equal to the real demand for money. You could divide through by the price level if you want to get that. Okay. That's really where real comes from. Okay. In the goods market, remember here, this is the IS. Okay. We had interest rates and we had income and we had a downward sloping graph. And, you know, this was showing us equilibrium in the goods market where savings was equal to investments, where the expenditures was equal to the income. And when we bring these together, we have a simultaneous equilibrium in the goods market and in the money markets. So when we bring those together, I should have had one more graph, too bad. When we bring those together, I'm going to draw it down below here. It's not too bad. Let's get rid of this. Okay. Let's put it down here. Okay. So, okay, income. So here I'm going to draw it right down here. So when we bring these together, we have the IS and we have the LM curve, and this is interest rates. And now we have the simultaneous equilibrium in the goods market and in the money markets at a specific interest rate. And this leads us to a level of output. That level of output, if I come back over here, remember GDP, I could call it GDP. I could call it output, which is Q. I could call it income, which is Y. Okay, GDP. This maps over to a point on the aggregate demand curve. Now, by combining the IS and LM curves, we can eliminate some variables. Well, we eliminate one major variable, interest rates, and we leave ourselves with a relationship between price and output, and that's the aggregate demand curve. So these points map over to the aggregate demand curve. And in the curriculum, there's an exercise where you're going to go through, and what you're going to do is you're going to find the IS equation, you're going to find the LM equation. How are you going to do that? You're just going to set the money supply equal to the money demand and solve for Y. You'll see the exercise there. Then you're going to bring those together to a simultaneous equilibrium at a specific interest rate. And this will map over to the point on the aggregate demand curve, which will tell us about the output level, the GDP. And so I think that exercise in the text is what you want to just walk through, okay? And if you're having trouble with it, don't go too far, okay, really, because I don't think you're going to be rewarded beyond just the basics. Like I said, this ISLM concept, it is something that I could write 20 questions on, on its own. I mean, it has chapters in textbooks on its own. It's just dropped into our curriculum, and it's linked to that fundamental relationship, which is what I think you should take away. Okay, so these were, a couple of really good questions. People were stuck on them. They just wanted some explanation. In these sessions here, I appreciate your flexibility, okay, in terms of, being able to do them. And